The irony, some of the best days often come immediately after the worst ones. So if you panic and exit after a crash, there's a high chance you will miss the rebound too. The best returns comes in sudden bursts. If you blink, you miss them. Market crashes are temporary, but missed opportunities, they are permanent. You don't have to be perfect. You just have to be present. Welcome to Mani Sutra, your go-to pit stop on the long journey of wealth creation. In today's episode, we are busting one of the biggest myths in investing. You've heard people say, buy low, sell high, or get in when the time is right. But what if I told you that trying to time the market could actually cost you more than just missed opportunities? Yep, we are talking lakhs, even crores sometimes, lost by missing just a few key days. So grab your chai, plug in your earphones, and let's unravel a story where patience isn't just a virtue, it's wealth. Have you ever missed a wedding function and later everyone said, "Oh, you missed the fun part. The food, the dancing, the drama." You smile politely, but deep down you feel left out, don't you? Now imagine that same feeling, but this time with your money. You stayed in the stock market for years, almost, but you missed just a few good days. And because of that, you notionally lost not a little, but lakhs, even sometimes crores. It sounds exaggerated, na? I promise it's not. Today, we will explore one of the most counterintuitive yet powerful lessons of long-term investing. Missing just a handful of the days in the stock market can destroy your returns. We will walk through the stories, the numbers, and mistakes most investors unknowingly make. So, you don't have to follow their footsteps. Now, let's begin with two friends, Amit and Rahul. Both are 35. Both started investing with 10 lakh in the Indian stock market in the 2009 era. That is right after the global financial crisis. They invested in Nifty 50 index mutual fund. Now, Amit had a patient nature. He believed in long-term investing, didn't check his portfolio daily, and rarely acted on headlines. He just invested and forgot about it. Rahul, on the other hand, was a bit jumpy. He kept reading news alerts, followed Twitter finance gurus, and often tried to time the market. "I'll sell now and re-enter when the things looks better," he would say. Now fast forward it to 2021. Amit's rupees lakh is now 60.9 lakhs, a whooping 509% return. Rahul's investment, well, it was only 30.9 lakhs, less than half of what Amit has done. Why? Because Rahul missed just the 10 best days in the market over that 12 years period. Just 10 days out of 3,000 trading sessions. That's all. The irony, some of the best days often come immediately after the worst ones. So if you panic and exit after a crash, there's a high chance you will miss the rebound too. Now, what's the data is saying? Let's put a real number to this. If you had invested 1 lakh in Nifty 50 in the year 2000 and stayed invested continuously for the last 25 years, up to April 2025 say, your wealth would have grown significantly, powered by compounding and staying in the market. But what if you had missed just that 10 best trading days? Your total return would shrink dramatically. And here's the kicker. Most of these bad days come during the bear market. That's right. Exactly what you listen. When the markets were full of fear and red ticks, those were the days that gave the highest single day return. People say that, no? Every dark cloud has a silver lining. Some of these dates you can check. October 13, 2008, May 18, 2009, March 25, 2020, April 7, 2020. Each one of these dates was in the middle of maximum pessimism. COVID crash, global financial crisis, election shocks. And yet, these were the dates that created maximum wealth. This tells us one clear thing. Volatility is not risk. It's an opportunity in disguise. Now, let's put it in another way. Cricket, our favorite pastime. You are watching an India-Australia match. It's a cliffhanger thriller. Now, you step away to take a call, grab some tea, scroll Instagram, and in this 10 minutes, you miss Kohli hitting a couple of sixes, or Bumrah bowling a wicket maiden, or Australia dropping a few crucial catches. The game turned while you weren't watching. Investing works similarly. The best returns comes in sudden bursts. If you blink, you miss them. And yet, many of us try to time the market. We hear the market noise, the global inflation, the election jitters, the US interest rates, oil prices, war, and we panic. Let's wait it out. Let's not exit and re-enter later. And here is the truth. It's time in the market, not timing the market, that builds wealth. I met Mr. Dotto during a seminar in 2022. He told me he exited all his equity funds in March 2020, thinking the market would crash more. He planned to re-enter when things stabilize. Guess what? He re-entered in August 2021 after the Nifty, which has bottomed out during COVID, had already gained over 100% from its bottom. He booked losses during panic and came back after the party was over. We often forget market crashes are temporary, but missed opportunities, they are permanent. And this is why SIP, that is systematic investment plans we are familiar with, work so beautifully. They help you stay invested, stay disciplined, and most importantly, stay in the game. You don't have to be perfect. You just have to be present. So what we can learn from all these? Lesson number 1, missing a few key days can reduce your overall returns by 50% to 90%, depending on the total number of days. Isn't that whooping? Lesson number 2, panic is expensive. Most of the market's best days follow some of its worst. So stay calm during downturns. Lesson number 3, have an asset allocation plan. A proper mix of equity, debt, gold, and other commodities that reflect your goal and risk profile can help you stay put when things turned ugly. Lesson number 4, you can't predict the base days. So stop trying. Even Warren Buffett says, the stock market is a machine designed to transfer money from the impatient to the patient. And trust me, patience pays. So here's the good news. The Indian mutual fund industry is on a mission. According to AMFI, which is Association of Mutual Funds in India, and PwC, we are looking at a Vikshit Bharat by 2047, and mutual funds will play a massive role in the journey. Our AUM, that is asset under management to GDP, that is gross domestic product ratio, is rising. Retail participation is growing, and long-term wealth creation through disciplined investing is becoming the norm. But this future belongs not to those who react, who panics, and who exits. It belongs to those who stays steady, stay invested, and stay optimistic, even when headlines scream otherwise. So thanks for tuning into Money Sutra, where money talks, but wisely. And if you enjoyed today's episode and found yourself nodding along or gasping at missed opportunities, please do us a favor. Hit the subscribe button, share this episode with your investor friends, and leave us a review. Because in investing as well as in life, sometimes the biggest returns comes from simply staying the course. So till next time, don't just chase return, chase wisdom, only on Money Sutra.